And I need you to listen very carefully because what is happening in the silver market right now has crossed from abnormal into dangerous territory. What we were watching just days ago as a widening disconnect has now escalated into something far more serious. Physical silver in Shanghai has traded at $77 per ounce. And that single number confirms that the global silver market is no longer functioning as one system. It has split in two. And when a market like silver splits, the consequences do not remain contained. They spread outward quietly at first, and then all at once. This is not a rumor. This is not speculation. This is not an online frenzy. This is a physical price being paid by buyers who need real metal, not contracts, not promises, not paper substitutes. A $77 price in Shanghai matters because Shanghai is a delivery market. It is where silver is bought to be used, consumed, and embedded into the real economy. When prices there detach violently from Western paper benchmarks, it signals that the assumed supply behind those benchmarks is not available. That is the core issue, and everything else flows from it. In a healthy system, a price difference like this cannot persist. It is mathematically impossible. Banks, trading houses, and arbitrage desks exist specifically to exploit price gaps. If silver is cheaper in New York than Shanghai, they buy it in New York, ship it to China, sell it in Shanghai, and collect a nearly risk-free profit. That process collapses the gap almost instantly. The only reason it is not happening now is because there is nothing to ship. The silver appearing cheap in Western markets cannot be sourced in physical size. It exists largely as financial exposure rather than inventory. Shanghai is paying $77 because Shanghai is bidding on reality. This development is worse than the earlier breakout because it confirms persistence. Prices briefly spiking can be dismissed. Prices holding at elevated levels cannot. Buyers are not backing away. They are accepting higher prices as necessary to secure supply. That tells us demand at these levels is not discretionary. It is compulsory. It is industrial and strategic demand that cannot simply wait for prices to fall. That is an entirely different market dynamic from what most investors are used to. Silver is not a luxury metal. It is not a decorative asset that can be substituted or deferred. It is essential to electricity transmission, renewable energy, electronics, telecommunications, medical instruments, and national defense. Entire sectors rely on it functioning silently in the background. When supply becomes uncertain, these sectors do not speculate. They secure supply aggressively. That behavior overwhelms paper markets because paper markets are designed for trading, not for survival procurement. What we are watching is the physical market asserting dominance over the financial market. This transition is rare and it is always destabilizing. Paper markets depend on leverage, liquidity, and confidence. Physical markets depend on inventory. When confidence in inventory collapses, leverage becomes a liability, liquidity becomes selective, rules change, and participants who believed they had exposure discover they had assumptions instead. Over the past 24 hours, additional warning signs have emerged. Delivery delays are increasing. Dealer inventory screens are thinning further. Wholesalers are quietly rationing product. Some are prioritizing industrial clients. Others are refusing to quote firm prices without confirmation of inbound supply. This is how shortages evolve in real time. They do not begin with empty headlines. They begin with friction. Friction becomes delay. Delay becomes rationing. Rationing becomes repricing. The most dangerous phase of a shortage is not when prices are obviously high. It is when availability quietly disappears. While most people still believe the quoted price represents something they can access, that illusion is now under threat. A $77 Shanghai price tells us that access is already constrained for those who must have metal. The difference between owning silver and having exposure to silver is becoming stark. If you are over the age of 55, this moment should feel unsettling for a reason. You have seen versions of this pattern before, even if they played out in different markets. Energy crises, credit freezes, housing breakdowns. In every case, early warning signs appeared first, premiums widened. Trusted benchmarks lagged reality. Confidence eroded beneath the surface. Then suddenly, the public realized the system no longer behaved the way they assumed it would. Silver is sending those early warnings now. It is critical to understand that futures prices can remain calm while physical stress intensifies. Futures markets reflect expectations, not stockpiles. They assume that only a small fraction of participants will ever demand delivery. The moment that assumption is challenged, the structure strains. When too many claims chase too few ounces, the response is never to print metal. The response is to manage claims. Cash settlement clauses, delivery deferrals, margin changes, and rule adjustments exist precisely for this scenario. They are not emergency inventions. They are built-in. A $77 silver price in Shanghai is not telling you how excited traders are. It is telling you how worried buyers are. Worry bids prices higher and sustains them. That is why this matters far more than a headline number on a chart. It reveals behavior. And behavior under stress is the most honest signal a market can give. Another factor that makes the situation more severe is timing. We are at the end of the year, a period when liquidity is typically thin and tolerance for surprise is low. Inventories are lean, staff is reduced, markets are more fragile. Under these conditions, shocks propagate faster. If this disconnect persists into the new year, when industrial contracts reset and strategic buying resumes, strain will increase, not decrease. Silver does not have the luxury of deep stockpiles to absorb that pressure. Many will argue that higher prices will fix the problem by stimulating supply. That belief ignores reality. Mining does not respond on monthly timelines. Refining capacity cannot be scaled instantly. Recycling responds unevenly and slowly. In the short and medium term, higher prices do not create more silver. They simply redirect existing supply toward whoever can pay the most. The process leaves others short. That is exactly what we are seeing. This is why the phrase market alert is not exaggerated. Not because silver reached a specific number, but because market structure is degrading. When structure weakens, volatility increases, correlations break down, and participants are forced into uncomfortable decisions. Markets do not like uncertainty, and uncertainty is rising. What happens next does not require a precise forecast to be understood directionally. Either physical supply improves substantially, or prices rise until demand is rationed. There's no financial workaround that manufactures ounces. Every delay in acknowledging that reality increases eventual adjustment. The $77 level in Shanghai is a warning beacon. It signals that buyers with real needs are no longer confident they can source metal later. They are securing it now. Once that mindset spreads, the process accelerates. This is how shortages move from manageable to acute. If watching this makes you uncomfortable, that discomfort is rational. Markets feel uncomfortable at transition points. Old assumptions fail. New rules are not yet fully visible. Those periods reward awareness and patience. They punish denial and overconfidence. This is not a call to panic. It is a call to attention. Silver has transitioned from a suppressed, paper-dominated market into a contested physical market. That shift is never smooth, and it rarely reverses without significant repricing. The fact that this breakout has gotten worse does not mean chaos tomorrow. It means pressure is building. Pressure exposes weaknesses. Weaknesses force change. We are now in that phase. As this unfolds, separating signal from noise becomes essential. Headlines will focus on dramatic price moves. The real signal will remain availability, premiums, delivery behavior, and who is willing to pay what to avoid failure. That is where truth resides in stressed markets. This story is not over. It is intensifying. The silver market is revealing realities that have been hidden by decades of financial abstraction. Those realities do not disappear because they are uncomfortable. They assert themselves through price, scarcity, and behavior. This is an emergency not because of fear, but because of function. Essential materials are telling us they are scarcer than the system believed. When that happens, the repricing process begins whether participants are ready or not. We are witnessing the early stage of that process. Now, what makes this phase especially dangerous is that the warning signs are no longer theoretical. They are operational. When markets begin to break, the first casualties are assumptions. The silver market is now burning through assumptions at an accelerating pace. The assumption that price represents availability. The assumption that paper exposure equals ownership. The assumption that delivery problems are rare edge cases. One by one, those assumptions are being stripped away. The $77 Shanghai price is not an outlier anymore. It is an anchor, and the longer it remains elevated, the more pressure it exerts on every linked market downstream. The Western paper price is struggling to keep up, not because traders are blind, but because the structure itself resists adjustment. Futures markets are designed to smooth volatility and delay recognition of stress. They do this by expanding leverage, rolling contracts forward, and settling differences in cash rather than metal. That mechanism works fine until physical demand overwhelms trust. We are now approaching that threshold. Each day that physical premiums persist, confidence in paper benchmarks erodes. When confidence erodes, participation changes. And that is when liquidity vanishes suddenly rather than gradually. This is where history becomes useful. Every major commodity dislocation followed a similar pattern. First, physical users quietly pay premiums. Second, inventories decline faster than expected. Third, delivery terms tighten. Fourth, financial markets attempt to suppress volatility through margin changes and rule adjustments. Finally, price gaps violently to reconcile reality. Silver is now between stages 3 and 4. That is not alarmism, it is pattern recognition. One of the clearest indicators that something is wrong is how sellers are behaving. In a normal market, rising prices attract sellers. In a stressed market, rising prices reduce selling. That inversion is now visible. Retail secondary supply is thin. Industrial scrap flows are inconsistent. Holders of physical metal are reluctant to part with it. This behavior tightens supply even further, amplifying stress on the system. When selling dries up at the same time, demand remains inelastic. Pressure builds exponentially. Another misunderstood aspect of this situation is the role of derivatives. Derivatives are supposed to distribute risk, but when the underlying asset becomes scarce, derivatives concentrate risk instead. Each contract represents a claim. When too many claims chase too few ounces, the system must choose which claims matter. That choice is rarely made explicitly. It is made through policy, settlement rules, and emergency measures. Those measures protect system stability, not individual expectations. This is where older investors need to pay attention. Many people believe diversification across paper instruments provides safety. In stable environments, that is often true. In stressed environments, correlations converge toward one, and paper instruments tied to the same underlying constraint behave similarly. The difference is not between stocks and metals, but between claims and control. Markets under stress reward those who control assets rather than reference them. It is also important to address the idea that this will somehow resolve quietly over a holiday period. That is unlikely. Thin markets amplify moves. Participants who must act will act regardless of the calendar. Industrial demand does not take vacations. Strategic procurement does not pause for sentiment. If anything, disruptions during thin periods carry forward with more force into active sessions because unresolved imbalances compound. The global aspect of this cannot be overstated. Silver is a globally traded, globally consumed metal. When a major regional market like Shanghai signals scarcity, other regions feel it soon after. Supply chains stretch across borders. Contracts span continents. A break in one node transmits stress elsewhere. This is why regional premiums do not stay regional, they migrate. As premiums migrate, price benchmarks lose credibility. Market participants begin referencing alternative indicators. Private deals replace public pricing. Transparency declines. This shift is uncomfortable but common in supply-constrained environments. It favors those with information and relationships over those relying on screens. Again, this is not theory. It is how stressed markets operate. Some will argue that governments or exchanges will intervene to restore order. Intervention can delay outcomes, but it cannot create metal. At best, it can slow repricing. At worst, it can deepen mistrust. History shows that interventions in commodity markets often increase volatility later by compressing it earlier. Pressure deferred is pressure amplified. The $7,700 Shanghai price is telling us that silver is entering a repricing cycle driven by necessity. That cycle will not end because commentary changes. It will end when supply meets demand at a new equilibrium. The journey to that equilibrium is rarely smooth. It involves false breaks, sharp pullbacks, and periods of apparent calm followed by renewed stress. Understanding that rhythm matters more than predicting each move. For those watching from the sidelines, the worst response is indifference. This is not background noise. It is a message from the physical market that financial abstractions have gone too far. When that happens, the correction process is inevitable. Ignoring it because it feels uncomfortable or inconvenient does not prevent it. It merely reduces preparation time. There's also a psychological element here that deserves mention. For decades, silver was treated as abundant, even mundane. Its critical role was overshadowed by its suppressed price. That cultural perception lingers. Markets are slow to update mental models. But physical markets do not care about narratives. They care about ounces. As those ounces become harder to secure, perception will eventually follow reality, often abruptly. As this unfolds, expect increased attempts to explain away the signal. You will hear arguments that this is temporary, technical, or contained. Some of those explanations may hold partial truth, but partial truth does not negate structural reality. The persistence of the Shanghai price is already falsifying many reassurances. Each additional day does further damage to complacency. Another risk factor is leverage. Many paper participants operate on margin. Rising volatility increases margin requirements. Higher margins force liquidation. Liquidation feeds volatility. That feedback loop can destabilize pricing further, especially if forced sellers overwhelm thin order books. This dynamic is not a sign of manipulation. It is a mechanical consequence of leverage meeting scarcity. When forced selling collides with unwilling sellers, prices gap. Gaps are how markets reprick quickly. The current divergence suggests that gap risk is rising, not falling. That does not mean straight line movement. It means discontinuous adjustment is becoming more likely for retirement to focused viewers. The key takeaway is not to chase price, but to reassess risk exposure. Understanding where vulnerabilities lie allows for thoughtful adjustments rather than reactive decisions. Stress reveals hidden correlations and hidden assumptions. Identifying those early is an advantage. This moment also highlights the difference between wealth preservation and wealth maximization. In uncertain environments, preserving purchasing power often matters more than extracting returns. Silver ES behavior suggests that purchasing power attached to real assets is becoming more valuable than nominal gains attached to claims. That shift is subtle but profound. It is worth remembering that markets do not announce regime changes politely. They telegraph them through anomalies. The $77 Shanghai price is such an anomaly. An anomaly that persists becomes a new reference point. That reference point recalibrates expectations everywhere else. As weeks progress, more participants will test the system. Some will request delivery. Some will withdraw from paper exposure. Some will secure private supply. Each of those actions tightens stress further. This is not because people are irrational, but because rational responses aggregate into systemic pressure. The emergency framing here is not about fear. It is about function and timing. Essential materials do not wait for consensus. They reprick when they must. Silver is communicating that moment has arrived. The most important thing now is observation without denial. Watching how delivery behavior evolves, how premiums behave, and how institutions respond will tell the real story. Price alone is insufficient. This is how markets teach hard lessons. Quietly at first, then unmistakably. The silver market has entered the unmistakable phase. This is not the end of stability everywhere, but it is the end of assuming stability where scarcity exists. The $77 breakout is confirmation, not speculation. The situation has gotten worse, not because of panic, but because of persistence. Persistence is what forces change. We are now watching that change.